Okay, the way I do it is I go straight. I always do, I like to do the trains, but it's not the purpose in this time. So for the areas, I will go like this, or just find the highs and the lows first. This one is one. No, it's not finished, is it? Okay, not here. Usually for the resistance, especially here, you can see this kind of retest here. There's lots of shadows here, stopping here. So for me, it's a big, like Ray calls it, danger area. So when I see that, the tops here, I'm gonna start drawing the resistance area, so the supply. This one over here. This. I put red because danger, no-go zone. I can adjust after. There's another one, so that's the lines. This is still a no-go zone. Change the color. Pretty much, yeah. That's my resistance. After I do straight to I go to the supply. So I'm gonna pretty much find the lows. It's more like this here. Oh. Pretty much. This thing in here can go down here like that. And the next one as well. Oh, yeah, this one. Make it in blue. Not here. And here you're gonna have some kind of here. So that's the next one it's gonna have to eat. Pretty much. He's also here. Now gonna go for the equilibrium. Pretty much the same. Oh, this one, it's really the one. It's too simple. Confirmation, no, it's not confirmed here. Orange for equilibrium, because it's still a support, but it's less powerful as the red one. Yeah, against this one. Equilibrium, then okay. And this one's moving again, so it's good. I have this. Can put, yeah, don't hurt. Okay. And now I'll put the global energy zone, red, and brown. Okay, good. Green, which is very big. Orange. The last one. Sport. So that's pretty much how I will do, guys.
Alright, beauty.
I will just follow the high and lows.
Cool. Thanks, Julian. Alright, and if you're gonna rate him, what would it be?
9. Pretty good.
Alright, Mike, if you're gonna rate Julian, what would it be?
Yeah, it looks fine. There's a lot of lines there.
Yeah, again, I
Mine as
get
well.
rid of them.
Oh, okay, so you clean the lines up at the end. Right, okay.
Yeah.
Okay, what will you give him, Mike?
I'll give him a 9.
Okay, in
So he's
terms
getting rid of
of
the lines.
in terms of instructional type, what will you give him?
So in what way?
Teaching,
Instructional?
yes, for you to fully understand it.
Yeah, I'll give him a 8 or 7. Yeah,
Okay, and?
Yeah, I'll give an 8.
Alright, cool. Very nice. Julian, so at least you can define like the equilibrium, support, resistance areas of suppliers of demand. And before I pass it on to you, Mike, I think I see something that I need to explain that I didn't explain actually fully. Right?
Okay.
I can pass into my screen right here. You should be able to see it right now. Okay. Who plays golf? Like, have you played golf, Julian?
I did once. I'm not good at it.
Not a problem. Mike?
No.
No? Well, you're a hang glider, right? So this also will relate into something. Okay. Step number 1, we're going to go through a step-by-step process. The first step is always to look at the current candle, because the current candle is what ascertains on the direction where you want to be. So at this point in time, who's in control, the bulls or the bears?
The bears.
Alright, so the bears, right? So the next question is, what is the probability that the price will continue to drop if you can see it something like this?
Yeah, 60%.
60%. Julian?
Yeah. Yeah, I would say the same.
Alright, so there is that slight probability that it will continue. Okay. Since it's like playing golf, the question is, if it's going to continue to drop, how far is it going to drop down to? And then when you're playing golf, if the ball is currently at 1.3699, what will be the flag? How far is the distance where the ball is currently at to where the flag is going to be? That flag is to identify the area of support or your area of demand, okay, putting your support line. So here in the past, you need to find basically where the last low of, or in other words, the peak. So notice how we have the peak over here, but the price has already been cut across. In other words, the price has gone through. So it has to find the next one. I need to go basically in the past. There's no way I'm going to put it over here to look into the trough. I need to get into the peak because that's the next one where it's going to drop down to. Alright, so why are we focusing on the highs and the lows?
That's the limits, I guess, of, yeah, where the buying and selling happen.
The limits of buying and selling, right?
I think its prior price is dictated by institutions, so they might want to retest them.
Okay, great. So the institutional price points, whether we like it or not. It's not you, me, a big bank. That could be a Deutsche Bank, UBS, that could be Goldman Sachs, could be anybody. So in order for the price to be resisted, remember at this point, this is your ceiling, right? This is level supply. But since the price is dropping, you need to find approximately where the price is going to drop down to. So that is your flag. And then from there, what you're going to be using, the question would be, we're going to use a putter, a 7-iron, a 9-iron, or a driver. There's no way you're going to use a driver in terms of finding your target point, because you get your target point on how strong it's going to be, I mean, there's a probability it can go over here. But the probability that it can go through here first is highly, highly probable. And then I had to go basically in the past, then there's no way that I can go through here and look at it. This one, or simply, it's already been dictated, it's already too far, that's already been too far. You can see here that within that high, I go through there, that's one. Also within that high, which almost touched from that high. Then I go through, there's a terminology in trading we call confluence. Confluence is simply price points on almost exactly where the price has been touched. Can price be touched almost at the same price point somewhere, sometime in the future, all the time?
Yes.
Sometimes yes, sometimes no, but it will go approximately to where it's going to go. So say, for example, that high right there almost touch, actually just went touch across through there, which is also almost, actually there's nothing, it's only 2 times. This high is similar to that high, that low got across within that low. So from this component, these 2 lines are a really valid line. There's, see here, this is your range. Is the price currently in the range of the demand? Between 136.86 and 137.08. So is the price currently level demand?
Yes.
Absolutely. So if buyers are supporting around this price point, there's two days in a row that basically failed. This is now where you're in a danger area that if you keep choosing to sell, your probability will decrease significantly. Why? Because now this high breaking out within that high. This high, if I take
Hello?
now, hello? Can you guys still hear me?
Yep.
Okay.
Yeah.
Right. This segment right there is an uptrend or a downtrend?
Uptrend.
Okay, it's an uptrend. Okay, how about this segment? It is an uptrend or a downtrend?
It's an up and down.
No trend.
So if that high broke through that high, what can we say now about that? Where can we now detect that in terms of a component of everything through here? Okay, and then I'll give you another one. How about here? Okay, I will change certain colors so we can differentiate between them. So here it's an uptrend, here's a downtrend and an uptrend. How about this segment right here?
Same downtrend and uptrend.
John says
It's still a downtrend, I guess. Yeah.
Oh yes,
right. How about you, Anne?
yeah, downtrend.
Oh, Anne is offline. So absolutely, it's a downtrend, right? Okay, how about this component? Oops, too dark. I want to make it nice and light. Alright, so how about now this bigger box?
Sideways.
An uptrend or a downtrend?
This is an uptrend.
What would you say, Julian?
Hello.
Hello?
Yeah.
What you
Uptrend.
An uptrend, okay. Julian, I mean, sorry, Mike.
Jeez. I'd say that's just going sideways.
Sideways, okay. Anne.
One side is an uptrend and the other side's still a downtrend. So it's converging to me, but
Yeah. It's
Yeah.
Okay.
These two trends.
Interesting. All right, I'll go back to the beginning part, right? Label. So everybody agrees this is an uptrend. How do I know that it's an uptrend? It is simply you have a series of, what's an uptrend again?
High highs, high lows.
Higher highs, higher lows. Okay. And then within this segment, there was a big question mark. Don't know whether it's an uptrend or downtrend. And then within this segment, so it is a downtrend. How do we know it's a downtrend? Easy. You can still see here. That's your highs, series of the highs, lows, going through that high for now, and then that high is still lower compared to those highs. Then from this segment, if the price chooses to go through here, then oops.
Hello. Oh, sorry.
This one is a painting, not drawing. What the? So here, if he chooses to go through in this end, it will still pretty much be a downtrend. Okay. All right. Let me add a line. red thick. Okay, then could be a downtrend if the price would go on this end. Alright, here's now the next one. Big one right here. You guys are converging sideways. Here's a high, here's a low, and check it. Trend is your friend. Actually did break. Okay, 1, 2. You are in an uptrend. 1, 2. Price is hitting a good level demand and also a trend. When a trend and a demand is currently being met, the only explanation, the next logical explanation for this is simply the price is going to go here, beyond that high. Okay, I'll make that into dark green, thick, bam. And that automatically means that you are in the same segment simply just a continuation compared to this. Okay. Which now becomes an uptrend on the bigger perspective. And how do I know that? If you go 6 months, notice how, So that being said, if I'm going to take everything, so it's really important to know, knowing the intermediate, the short term, medium term, longer term. If you are more on the longer term, then definitely I'm very bullish with the euro against the dollar. This is just a minor correction compared to what's happening right now. Clear cut on the breakout within this one right here. This is this 1 to the 3rd box. This is just your minor correction of the bigger perspective right here. See? 1, 2, 3, 4. Notice how the highs are higher compared to the previous highs, the lows are lower compared to the previous lows. So just be careful in the way how you look into things. This is what now part of our perception simply in trading. You choose only to see what you want to see rather than seeing exactly what the market is actually really telling you. So does that make sense to all of you guys?
Yep.
Okay. Now to identify simply, okay, if you're buying, see how the price is currently rebounding. Now, if you're going to buy right at this point in time, it's a level demand. I know the bears are in control. There's no confirmation that it's going to be the low. By tomorrow, we're going to see a confirmation for sure. And if there's a higher high, higher low will be the next one. If there's going to be a rebound, this is now where we need to define as well our resistance area, or finding a level of supply. I need to find where the last high is. That is the last high. Here's also simply the last high within the actual trend itself, really powerful one. Then you have the mini ones over here. That's 1, 2, 3, and the biggest of them all is this guy right here that they need to be at 38.924. So if the price chooses to head back up, then you have different levels that this is the next one. You have a range between 37 all the way 37, 71, 40 pip range. Okay, now you're gonna put dark to blue. And then you have these three right here. I'll put pink for now. And of course, the biggest of them all will do. We can't really color code them because there's really nothing in the past, because that's the highest it's ever been since I don't know when, right? So the two major ones that they have to beat is first, that if it chooses to break the rebound, back 1. Next one here, 2. And you'll be able to tell the distance anyway from bottom to top. That's approximately 212 pips, bottom to top. 129. In actual fact, bingo, it goes beyond 212 pips. So this is the next distance that it will lead to, approximately here, by first week of March. That's if it chooses to go through within the same level. Okay, so now these are pretty much advanced trading techniques, but just to demonstrate that depending on the way how you see things, if you're a day trader, that's it, you're done. That's all you can basically get. If you go through in terms of a, say, a 1 hour chart, see how you're in this range, particularly on this good long level demand. Overall, I mean, here's really sharp moves to the downside, but there's all the possibility that on the medium to longer term, buyers will start pushing the price to go to the upside, right? So shorter term, that's all basically you can gain from a level supply perspective all the way to where the demand is 71 pips. Okay, on a medium, actually not medium, it is still pretty short. So based on a day trading, in terms of the daily chart, 1, 2, that's pretty much it. We're going to see one more as a form of a confirmation whether if this low is really the low. But the next logical explanation, once we have a new clear cut that this is the low part of a rebound, then your distance from where the level demand to the next one is about 120, all the way to there is about 100, 200 pips, which will create to break that last high right there. But you see, the market doesn't go in a straight line. It has to drop, go back and forth. You can also see it here as well, actually. From low to there, 200 pips, 197. From there to there, 120 pips. Here to here, about 196 pips. Or they could still come back on here, around this level. Okay. And then 200 pips, 120, nothing dictating here, just flat. But on the downturn, it's actually massive right there. 270, 270, pretty cool. Okay, 144, 100. Actually, this one is a bigger one, 197, because it didn't create the lower high. So. But within this perspective, yes, about 210, 214. Next one is about 210 as well. So either create a new higher high or lower high, retest, and it will fail again for second time of a test. Come back down, create correction. Try and retest until basically will break, because that person right there is massive. It's huge. Alright, so that's pretty much it in terms of identifying. So this is pretty much where demand, supply, that is an equilibrium area. Now if this one fails, then you go through one step below once again. Then you need to find where the next one is going to be. So the next one is simply within that low. And as I'm creating a lot of stuff right here now. So that's 1, That's 2 right there. Just going through basically in the path from where the peaks and the troughs. That will be the easiest. Here, of course, you have a major one right there. Low. Also need to look basically in the past right here. Oh, see, that's one right there too. See, there's one. High long legged dirges, so those are simply news based, they're waiting on something. Then here, so this 2 portion, that is an ultimate one too that they need to test. And then you have that similar to what Julian basically drew. Then, of course, these major kahunas right at this point in time. Okay. Okay, within that low. Alright, so I'll go back in terms of the steps. Step 1, look at the current bar, who's in control. Then find the level of demand. Level of demand. Okay, level of demand is pretty strong, and then the trend is pretty much up. If it chooses to continue to go and rebound, then I need to find my level of supply. Level of supply is basically within, looking to the past, looking at the peaks. Demand, looking at the troughs and the peaks, where the peak becomes now a demand when it basically breaks, right? So from that component, if it chooses not to go further, it will break through there. Then where's the next one? Then I'll find all the peaks based in the past with the last one right there in order for it to beat. If it fails, then I will find everything based in the past in terms of either the troughs or also the peaks that were occurred in the past. Sorry, there's also one right there. Okay. That's why the highs, the highs and the lows are definitely really important. Okay, because those are your institutional price points. And they don't go exactly to where the price point is going to be, but to make it really objective in terms of the way how you draw your support and resistance lines, or to identify the range, is simply your highs and the lows, which is now the peaks and the troughs of the actual trend. Okay, so in this particular case, notice how the level of demand has a range between 136.86 and to make it bigger, 136.23, 136.86, and I don't know what the price is, 137 something, so 137 something, 137.09, okay, 137.10, so 86, 37.10, like a 30 pip range of a level of demand. But the biggest of them all is simply around this level. Because if you magnify it to a smaller time frame, you will actually really see it. See, these two ones, really strong based on this component right there. Okay. Alright, so that's pretty much on how you would be able to dictate on much more detailed. Any questions based on that?
Yeah, just regarding the equilibrium part of it, I guess. How do you really define that? Or, yeah, I'm still not quite sure about that part of it.
Got it. Equilibrium is simply the average of something, right? Between 2 points, between 2 ranges. So say for example this one. If this one fails, the next one is going to drop is over here. Then this one is now the equilibrium. And this one will be the major support. But if this one chooses to rebound, then this is where the last price is simply an equilibrium point where they need to decide whether if the price will continue to go further, or it's simply a deciding area, a decider point. So watch, if I put, say, a moving average, Doesn't matter which one. I'll just put 10 for now. And I'm going to make a line color where it's going to be nice, and I'll put red. So if I can see here between the top and the bottom here, the moving average, this is where the equilibrium is currently where it's at. But if this one chooses to rebound to go to the upside, then this becomes the equilibrium. This will be your demand or your supply, where the calculation of the moving average will be coming through here somewhere at one point in time, right? So that's how they normally operate, and hence is why any moving average indicator is always going to be at retail like a 50-50 chance, because that's where they're dictating should I not. So if I go to more of a smaller time frame, notice how the moving averages is now within that equilibrium area. Right? So the smaller the time frame, you can actually really see way more clear. So within equilibrium, this is where the price is at this point in time based on the level of demand. But if they choose to rebound, then on a bigger time frame, this won't become your equilibrium. It will change into a this will become the equilibrium. This will become now the supply, right? So that's pretty much how they operate. And then if this one fails, this will become the supply. This becomes the supply. This will become the equilibrium. This is the main demand. And if this one fails, this will become the main demand. This will become the equilibrium. So they go in hierarchy, step by step.
Yeah, I suppose my problem is with naming these coloured rectangles you've drawn. Sometimes I guess should we be naming them as what they are like at now? Do you know what I mean? Because like in the past, like I've drawn some of the ones I submitted before. Some were support, now they're demand. Supply, and now they're demand, or the other way around. Should we be naming them as to, I guess, the current relevancy, or do you know what I mean?
Absolutely. You're like, yeah, I know what you mean. So anything that is in where you're looking at, so the first step is always look at the current bar, and then to dictate on where the direction is going to be. So based on the current bar, that will be always either your supply or demand. So at this point in time, this is going to be your demand where buyers are supporting. So in other words, it will be your support. If this one fails, then it becomes now a supply or resistance. The next level of demand, or where it's going to be, is one right here, right? So that's how you can define. So the actual goal is just to, as much as we can, is to be objective in how we draw our support and resistance lines. And to draw the support and resistance lines, just identifying where is actually the highs and the lows of the actual trend based in the past. And you can see more touches. That's you can get the strongest demand or support. But in terms of the range itself, since price cannot go automatically on the same price somewhere in the past all the time, it's like going to an auction. A value of a property doesn't go automatically to 500,000. Just because based in the past it's valued at 500,000, someone will be bidding it above 500,000 somewhere sometime in the long run. It could be 510, 505, and then later on they're going to say, "Ooh, too expensive. I'm not going to go to 510. I'm going to bid at 505. If no one's bidding, it's going to be on at 505. So it will create that price point of a resistance price point approximately on where they're going to be. Because why is it important why we're doing this? Because when we get to the intermediate as the form of a target point, you would be able to create a target point approximately on where you can get taken. Because if you just want all the time, I want the target point to where institutional price point is going to be. Seen it over and over again, they won't actually take you. But because you have a range, and now if you're not being greedy, you take the median component. So if the range between 36.86 and 37 say here 37.10. So if you put your target point at 37, guaranteed, almost guaranteed, that they will take you in terms of your target itself. Now, if, say, to the upside, your target point, if you want to go through, you said, oh, well, I want my target point at 37.90. There's no way they'll give you, they will take your 37.90. It's such a small person that we are. You know, we're pretty much irrelevant into the marketplace. They'll just pretty much laugh at us, and you can say no. So you gotta wait until yours will be taken. But if you choose to rebound, you're gonna say, well, I'm gonna put my target point at 37, say 50, which is in between 37.38 and 37.70. The probability that you're gonna get taken out is highly probable. So to define an area of demand, area of supply, that once you get to a stage where, all right, I'm gonna go long based on this. Here are those potential target points I'm gonna put in based on where I believe and see fit, then that's where I'm gonna put it in. So yes, it is very subjective in terms of the target points, but it's giving you also the ability, the freedom to choose on where you want to put your targets, because at the end of the day, everybody's different in terms of the risk component. Some are willing to take more risks, some are willing to be risk averse and to take any risks. In terms of target points, some also will be more riskier to go through beyond a certain price point than to others. Because if you're saying, if I'm going to say, okay, I'm going to put the target point at 137.47, but based on what you believe in, you're going to say, well, I know I'm going to get taken 37.50. That's why in trading, there's actually really no right or wrong. What makes a trading methodology objective as a point of entry and point of exit is if we use different strategies, like using fibs as a target point, for example. But the two methodologies that you'll be learning, they're highly objective because it's given based on the stop. The entry is highly objective, the stop's highly objective. The targets, their strategies are highly objective, but it also gives you the ability to choose your other target points based on one strategy. By the time you get to the advanced, now there's a different scenario once again, where you're just definitely trading based on supply and demand and using price action trading. All right, so I'll stop through there. We'll practice a little bit more, and then on the next class, I'll let Mike, it'll be your turn. So I hope that make it a little bit more clearer. I know that Anne pointed it out in terms of your homeworks, in terms of identifying the highs and the lows, and then the only thing that I can basically, the deficit that I saw is simply, you identify the highs and the lows, you're putting into it, but I just want to reiterate is simply looking at the current candle first, and then find a direction of where the price is going. If it's dropping, then that's where you have to go through and draw your demand and search for the area of demand first. If the price is going to the upside, so say for example you're on this end, if you choose, the bulls are just way too much powerful, too much in control, then this is where you need to identify where can I now put my find a level of supply where the price is going to be. And then you can see here, okay, great. So there's certain ranges that it can go based in the past, here between 136.86 and 37.15. And if it surpasses over here, then they will surpass this at 137.38. Surpasses that, then you can go to all the way 37.71. And then bingo, that's where the price hit after a few days, right? But notice how when the price decreases in strength, they're retesting and creating some form of uncertainty because you're in a good strong level of demand or supply right at this point in time. It only takes just one more push or some form of news in order to break the supply level to go through beyond that. So in my own perspective, like say if you're analyzing it, it doesn't go in a straight line. It has to correct itself back to level demand, because if you look at this, 1, 2, 3, 4, 5, big push here all the way to go through 184 pips, and then from here to here it's at 80, 90 pips. All this they're simply doing is that, well, I need to give back to the markets. It's simply, this is profit taking, creating a little bit more demand, and then when there's more demand, then the price will continue within the force of momentum based on that. Alright, so that's why once we get to the next level of certain things, or in terms of the program, we're going to put everything two and two together. Force, lack of force, continuation of the force. Right, so that's how we can really fully read price properly, or price action, read the candles or technical analysis. And at the end of the day, I'm just preparing you when you get to the advanced level. This is the most important part, is this component where the future doesn't exist. So that's why I'm going to ask you guys a question. What do you see? And you only saw based on what you want to see, based on the current one. Why? Because at this point in time, your brain is not trained to see where the price should be over here. That's why you want to train yourself, is where is the price going to be? I can see that the next logical step is to create a new higher somewhere, sometime in the long run. And in the middle portion, there's an uptrend, there's a downtrend, but what is the bigger trend? So all these type of things. All right, any questions?
Nope.
Nothing. So please continue in terms of your homework, in terms of defining supply and demand, drawing your support and resistance, and then we'll keep on continuing that up to next week. And then we're going to combine your trends and then your supply and demand. Then when you get to the intermediate, we're going to go talk just a few things like what type of patterns that are really good in trading, how can we be used, and we're going to talk certain indicators that could help the analysis, and then Bob's your uncle. If there's no questions,
rich.
oh yeah, so that's where the consistency comes into place, right? And trading is easy, you know. Just I can't say anything else, but you know, it is easy, that easy, to be honest. All right, and the only thing that like messes us up, like I said, is the 6 inches between our ears. It's just a matter of believing in yourself, right, and how you can do it, your ability to do it. Okay, if there's no questions, then I look forward to more of your homework, and we'll see.
Ray?
Yes, Julian.
Yeah. I see you recording right now.
Correct.
Are you gonna put on the website?
Yes, I am.
Yeah. So on the website there is just 6 vids, and I can't access to more vids. I don't know if it's normal or not.
No problem.
It's the 6th of this year, I guess.
Gotcha.
And, yeah.
No worries. I will actually check it out and get that updated.
Okay.
Alrighty. No worries, guys. You have a good one.
Right, thank you very much.
Ciao.
Thanks.
Bye.
Bye.
Oh, see you
ya.
tomorrow.
Bye.
Live trading. Bye.